Stop what you're doing right now. Put the sandwich down. Yes, even mid-bike. Pull over if you're driving. This matters more than whatever you are doing. Are we clear? Good. Ladies and gentlemen, Asian guy here. It's Tuesday, January 13th, 2026. And what I'm about to tell you should make you angry. Yesterday, silver broke through $85 an ounce. Shanghai traded at 93. The arbitrage was dying. The paper market was losing control. For a brief moment, reality won. Then, while you were sleeping, the empire struck back. Late Monday night, the Chicago Mercantile Exchange, the CME, quietly issued an emergency margin notice, effective immediately, not next week, not next month, today. They changed the rules of silver trading in the middle of a historic breakout. Not to protect the market, not to reduce risk, but to force retail traders out and protect banks that are bleeding on massive short positions. This is not speculation. It's documented. I have the numbers. Here's what they did. One silver futures contract controls 5,000 ounces. At $85, that's $425,000. Under the old rules, margin was about $32,500, roughly 13-to-1 leverage. That leverage is how retail competes. And that's exactly what the banks fear. As of today, the CME scrapped fixed margins and replaced them with a 9% notional requirement. At $85 silver, that's $38,250. An overnight increase of nearly $6,000 per contract. A 17% jump. No warning. If you were fully allocated, you woke up to a margin call. Either add cash immediately, which most people can't, or liquidate. When thousands are forced to sell at once, price drops not because fundamentals changed, but because the rules were changed to force selling. That is manipulation. And it's not new. In 2011, the CME raised silver margins 5 times in 9 days. Silver crashed, then recovered, then surged again, until they did it once more on a Sunday night, sending silver from 50 to 42 in one session. That day became known as Silver Sunday. Now it's 2026. Silver breaks 85. Shanghai trades 93. And the same playbook is back. Margins raised. Forced liquidation. Manufactured fear. And this time, they're even more desperate. Here's what they don't want you to realize. This manipulation didn't work in 2011, and it will not work now. Yes, margins crushed price back then. Yes, weak hands were shaken out. But the fundamentals never changed, and silver eventually exploded anyway. This time, the setup is even more dangerous for them. While the CME is manipulating paper rules, the physical market hasn't blinked. Shanghai is still trading at $93. That's an $8 premium over COMEX. U.S. dealers are charging $8 to $15 over spot. Mints are reporting weeks-long delays. Nothing physical has loosened. Nothing fundamental has improved. The only thing that changed is the paper casino. And now zoom out, because this is where it gets bigger than silver. One of the most respected macro analysts alive, Tom Bradshaw, just identified what he calls the 38% signal. He studied every major economic cycle of the last 50 years. The result? Whenever gold rises more than 38% in a single year, a severe recession follows within 12 months. No exceptions. Every time. And in 2025, gold rose over 40%. The signal is active. Bradshaw believes the next phase is a short, violent liquidity crunch where everything sells off as margin calls spread. Stocks, bonds, crypto, even metals. But then comes the second phase. The Federal Reserve prints. Liquidity floods the system. Confidence in paper dies. And that's when gold and silver go vertical. This is exactly what happened in 2008. Gold fell first, then ran from 700 to 1900. Silver fell to 8, then exploded to 49. According to Bradshaw's projections for this cycle, gold targets $9,000. Silver targets $375. Not hype, not fantasy, historical math. Now connect the dots. The CME raised margins now because they see what's coming. They know the recession signal is live. They know the Fed will be forced to print again. And they know banks are catastrophically short silver. If retail is still positioned when silver goes vertical, the banks are finished. So they change the rules early. They force liquidations. They manufacture fear. They try to clear the board before the real move begins. But here's the problem. They can change paper rules all they want. They cannot create physical silver. They can't force China to export. They can't stop industrial demand. They can't build missiles, solar panels, or EVs with futures contracts. Paper can be manipulated. Reality cannot. That's why physical silver is the lifeboat, and paper silver is the Titanic. If you hold physical, don't sell. If you're trapped in futures, exit the casino and go physical. If you're not positioned yet, this pullback is the opportunity they need you to miss. This is the last shakeout before the real move. The margins were nuked because the system is scared. The rug pull is confirmed. The shortage is real. And when your enemy is desperate enough to change the rules, that's when you know you're on the right side of the trade. 375 is coming. The timeline is accelerating. Hold the line.